What do you tell people who feel that venture capital is a little bit too risky for them?
A venture capital, in my opinion, at least, it is not as risky as the public markets. And one of the key reasons is that there is a concept of preferred shares. And simply put, what that means is that the investors who have invested cash are going to get their cash back first, which means if a company loses value, the investors are still protected. That is the key thing that makes venture capital not as risky as people think it is. So for example, if I invest $20 million in a $100 million company and that company's value is cut in half, I still get my 20 million back dollar for dollar, or 20,000 back dollar for dollar. And that's one key thing. The other key thing is that, like any other investment, if you put all your money in one company, it's a bad idea because that company can do great, but that company can also go out of business. The third thing that we do is that we look for companies that are close to an exit. An exit can be through an IPO, where they are listed on a stock exchange, or it can be an acquisition. So these companies are well established. They typically have revenues in hundreds of millions of dollars. We do not invest in small startups. In fact, I really, really advise people not to invest in the early stage at this time. It is one of the worst times to invest in early stage. The risk is at the highest, and so is the valuation. So generally, when the risk is high, the valuation is low, but it's a very strange time that the valuations and the risk are both very high for early stage investors.